Most Americans spend less than 30 minutes choosing their health insurance during open enrollment. They log in, see their current plan is still available, click confirm, and move on with their day. It feels like a responsible financial decision. It is almost never one. I have to admit, I used to do exactly this, log and repeat the options I selected the previous year. Here is what happened while you weren't paying attention. Your employer quietly raised your deductible. Your premium went up. A drug you depend on got moved to a higher cost tier. And your doctor, the one you've seen for 6 years, just moved out of network. None of that showed up in a notification. None of it required your approval. It just happened, and you just agreed to all of it. In 2026, the average health benefit cost per employee crossed $18,500, which is the steepest increase in 15 years. Employers are absorbing some of that, but more than half of large employers have already confirmed they are passing a significant portion of that cost directly to you through higher deductibles, higher copays, and tighter networks. Open enrollment is not a formality. It is the one financial decision you make every year that can either protect your family or quietly drain it. I'm going to give you the 5 questions to ask before you accept anything this open enrollment season. Stay with me. Question 3 is the one that catches people completely off guard and costs them the most. Welcome to Quick Financial Concepts, where we help you make smarter financial decisions by asking the right questions first. Subscribe so you don't miss what's coming, because this open enrollment season, the stakes are higher than they've been in a decade. Before the 5 questions, let me give you a clear picture of what your employer is dealing with right now, because understanding their pressure helps you understand why your plan may look different this year. Employers are staring down a 9% to 10% jump in healthcare costs for 2026. That is not a rounding error. It is the largest projected increase since 2010. The drivers are rising prescription drug costs, especially the explosive demand for GLP-1 weight loss medications like Ozempic and Wegovy, plus higher utilization of specialty care, cancer treatments, and chronic disease management. Employers have 3 options when costs spike like this: absorb the increase, raise your premiums, or shift costs to you through higher deductibles and out-of-pocket maximums. 51% of large employers have already said they plan to do the third one this year. Many will do some combination of all 3. What that means for you, the plan you enrolled in last year may look similar on the surface and cost significantly more in practice. That gap between what looks the same and what actually changed is exactly where these 5 questions live. Question number 1, did my plan actually change, or am I just clicking through again? This is the question that 44% of American workers never ask. According to MetLife's annual benefits study, nearly half of employees didn't consult anyone or review anything before re-enrolling last year. They just clicked confirm, and a meaningful number of them spent hundreds to thousands of dollars more than they needed to because of changes they never saw coming. Here is what can change in your plan from one year to the next without any dramatic announcement: your deductible, your out-of-pocket maximum, your copay structure, your premium, the drugs covered on your formulary, the providers in your network, and the specialist referral requirements. Any one of these changes can significantly alter what you pay out of pocket in a given year. All of them can change simultaneously. What to do? Before you do anything else during open enrollment, pull up your current plan's summary of benefits and coverage document from last year and place it side by side with this year's version. Your HR department is required to provide this. Compare 4 numbers specifically: the annual premium you pay, the deductible, the out-of-pocket maximum, and the copay for a specialist visit. If any of those 4 numbers changed, your financial exposure changed. Do not re-enroll until you understand by exactly how much. Question number 2. What will this plan actually cost me? Not just monthly, but all the way through December. This is the most common and most expensive mistake made during open enrollment. People choose a plan based on the monthly premium, the number that shows up in their paycheck, and completely ignore the rest of the financial picture. Here is the math that actually matters. Your true annual cost of a health plan has 4 components: the annual premium you pay, your deductible, your co-pays and coinsurance on top of the deductible, and your out-of-pocket maximum. That last number is the ceiling, the most you could possibly pay in a calendar year beyond your premium. And in 2026, out-of-pocket maximums for employer plans can run $5,000 to $9,000 or more for an individual. Let me give you a real example. Plan A has a $200 monthly premium and a $4,000 deductible. Plan B has a $350 monthly premium and a $1,500 deductible. Plan A looks cheaper every month. But if you have a surgery, a serious diagnosis, or even a string of specialist visits, Plan B may cost you thousands less over the course of the year. The premium is just the entry fee. The deductible and out-of-pocket maximum determine your actual financial risk. What to do? Build a simple worst-case and expected-case scenario for each plan your employer offers. Worst case, you hit your out-of-pocket maximum. Expected case, you have roughly the same healthcare needs as last year. Add annual premiums to each scenario. The plan with the lowest number in your expected case scenario, not your best case, is usually the right choice for your household. Question number 3. Are my doctors, my prescriptions, and anything I actually need still covered under this plan? This is the question that catches people most off guard, and the one that generates the most painful surprises in January, when the new plan year starts. Networks change. Every year, hospitals and physicians renegotiate contracts with insurance carriers. A doctor who was in network last year may have dropped out of your plan's network entirely. And if you see them without knowing that, you could be billed at out-of-network rates, which can be dramatically higher and may not count toward your deductible at all. Prescription formularies change too. The drug you take every month may have been moved from Tier 2 to Tier 4 on your plan's drug coverage list, which can mean your monthly cost triples or quadruples overnight with no explanation beyond a formulary update you never received. And if you are one of the millions of Americans currently taking or considering a GLP-1 medication like Ozempic or Wegovy, this point is especially critical. While approximately 45% of large employers now cover these medications for obesity, up from just 25% in 2023, coverage varies dramatically by plan and by employer. Some cover it for diabetes only. Some require prior authorization. Some have dropped coverage entirely due to cost. Do not assume coverage continues. Verify it explicitly before you re-enroll. What to do? 3 checks before you sign anything. 1. Go to your plan's provider directory and confirm your primary care physician and any specialists you use are still listed as in-network. 2. Look up every prescription you take on the new plan year's drug formulary and confirm the tier has not changed. 3. If you take a GLP-1 or expect to need one, call the insurance carrier directly and ask, "Is this medication covered? What tier is it? And what is the prior authorization requirement?" Get the representative's name and the reference number for that call. Question number 4. Is my employer quietly shifting costs to me, and is there a smarter plan option I'm ignoring? Here is the financial reality that most employees never hear stated plainly. When your employer raises your deductible to manage their healthcare costs, your wages are effectively being cut. Researchers at the Federal Reserve Bank of New York found that rising employee health insurance costs are directly dampening wage growth. Workers would have received approximately 1 full percentage point more in raises last year if healthcare cost increases had held steady. You are not just paying more for insurance. You are being paid less, so your employer can manage their insurance bill. Understanding that reframes open enrollment from an administrative task into a compensation negotiation. With that context, here is what most employees don't do. Seriously evaluate the high-deductible health plan option if their employer offers one. An HDHP typically has a lower monthly premium than a traditional PPO, paired with a higher deductible. What makes it worth a serious look is what comes attached to it: eligibility for a health savings account. An HSA is one of the most powerful tax advantage tools available to any working American. Here is why. An HSA has what financial planners call a triple tax advantage. Contributions go in pre-tax, reducing your taxable income today. The money grows tax-free if you invest it. And withdrawals for qualified medical expenses, now or decades from now in retirement, come out completely tax-free. In 2026, you can contribute up to $4,400 as an individual or $8,750 for a family. Many employers also seed your HSA with contributions when you enroll. An HSA is not just a medical account. Funded consistently and invested, it becomes a powerful secondary retirement account, because after age 65, you can withdraw for any reason, paying only ordinary income tax, just like a traditional IRA. What to do? If your employer offers an HDHP with an HSA option, run the math. Compare the premium savings over the year against the higher deductible exposure. If the premium savings get close to covering your deductible difference, and especially if your employer contributes to the HSA, the HDHP may be the financially superior choice even if you use healthcare regularly. Question number 5. Am I leaving tax-free money on the table? Whether you choose an HDHP or a traditional plan, this question applies to every working American with access to employer benefits. And the answer, for most people, is yes. If you enroll in an FSA, a flexible spending account, you can set aside up to $3,400 pre-tax in 2026 to pay for qualified medical expenses. Copays, deductibles, prescriptions, dental work, vision care, and even over-the-counter medications. Every dollar you put into an FSA reduces your taxable income, which means the government is effectively subsidizing a portion of your healthcare costs. The critical warning on FSAs: they operate under a use-it-or-lose-it rule. Contribute $3,400, spend $1,800, and you lose the rest at year's end, with a carryover cap of just $680 allowed for 2026. So the strategy is straightforward. Look back at what you actually spent out of pocket on healthcare last year and contribute that amount, not a dollar more. If you are in the HDHP with the HSA lane, the equation is different. Unlike an FSA, an HSA has no use-it-or-lose-it rule. The money rolls over indefinitely. Fund it every year you are healthy and don't need it, invest it, and let it compound. A 30-year-old who maxes out a family HSA for 20 years and invests the balance at a modest return could have well over $400,000 in tax-free healthcare purchasing power at retirement. That is not a small number. It is a retirement strategy hiding inside a benefits form. What to do? If you currently contribute 0 to an HSA or FSA, set a contribution for this enrollment period, even if it is not the maximum. A $100 a month FSA contribution saves the average worker $300 to $500 in taxes annually for doing exactly what they were already going to do: pay their medical bills. Now, today's final thoughts. Ask these 5 questions before you accept your employer's health insurance during the open enrollment period. 1. Did my plan actually change, or am I just clicking through again? 2. What will this plan actually cost me, not just monthly, but all year? 3. Are my doctors, prescriptions, and everything I need still covered? 4. Is my employer shifting costs to me, and is there a smarter plan option? 5. Am I leaving tax-free money on the table with an HSA or FSA? Open enrollment is open for a few weeks. The decisions you make in that window follow you for an entire year, and some of them, like HSA funding, compound for decades. Give it the time it deserves. If this video helped you see your benefits package differently, share it with one coworker before open enrollment closes. The person sitting next to you at work has the same options you do, and they may not know any of this. Subscribe if you are not already here, and drop a comment below with this: What is the one thing about your health insurance you have never fully understood? We read every comment, and your answers drive what we cover next. And remember, your employer chose these plans with their budget in mind. Open enrollment is the one moment each year when you get to choose with yours.